Well, for the derivatives, there are two purposes of having that. First is it serves as a hedge against the or a hedge or as a speculation. Like for the purpose of if you are going to protect the value of a commodity and you buy a derivative, it means to say that you are hedging the fluctuation of the price of that commodity. However, if there's no reason for you to do that, just to buy your hedge. For example, if someone who originally issued that derivative and you are the second person who buy that, then again there's another third person. Then I think it's not your intention if you're the third or the second or third person buying that option. It's not or derivative. It's not your intention to have that hedging because you don't care about the underlying transactions. But what you will do is just to speculate something. But again, the in actual, it's not really a concern to know whether it's that for speculation or for hedging. So as long you have that, you have the derivatives and you gain some favor for the fluctuation, increase in the value of that, then you can sell that. Then that's the I mean you end up with your purpose of having gaining some money out of it. So it's not having to know is whether that's hedging or um, speculation. Okay, so to review, the what's the difference between physical assets markets? Physical asset markets, that's like the public markets that we have, like in the Walmart, groceries, items, appliances, we have or auto vehicles. Those are, and the financial assets markets are those that are selling securities, financial securities like bonds, stocks, securities, shares of stocks, like the derivatives, mortgage, like that. Second is what's the difference between the spot market? Spot means it is a now transaction. Futures is a future. It is a now contract, but transactions is to be held in the future. Distinguish between money markets and capital. Money markets are extremely liquid, like 2 months, 1 month, 30 days, like that, 45 days. Very liquid for those that are highly conservative investors. For the capital markets, those who wants to gain some controls or like influence over the corporation because maybe they have some certainty about the outcome of the operation. So they want to gain in the long run, in the long term interest of that. The difference between the primary markets are those stocks that were issued for the first time. So as I said earlier, it's like if you have some unissued and you have issued already, those issued that are sold by a holder of the shares of stocks and sold with another buyer interested with that stocks, that is the secondary markets. So but the primary markets are those that are newly issued. Differentiate between private and public markets. Private that are dealing that the is a security between the two parties or more parties, but their dealings is that the securities are not available for the other parties, only between them or among them that are stipulated in the contract. But the public markets is different. So it's your securities are listed in the public. So at any time, with even without your consent, the other party can sell the securities that they are holding. Why are financial markets essential for a healthy economy? Of course, an economy needs funds, and the financial markets are there to get those funds from those who have surplus or savings, and those funds will be invested to the economies, and those investment to the corporation will be now is support a backbone to the healthy economy. They will boost the economy. So the more funds that are available in the financial markets, the more money to be invested in the company, then the growth in company is really unbelievable. Okay.